Hey everyone, welcome back. This is Cameron Armstrong with Grider Peterson Real Estate Team at eXp Realty in Idaho Falls. I'm here today with Brady Bell from Bell Financial Group, and we want to talk about the different types of loans there are for residential mortgages. And not all loans are created equal. Some of them have specific requirements, and Brady's going to tell us all about that. Brady, let's start with a conventional loan. What's the parameters for a conventional loan? What is it basically?
Yeah, so a conventional mortgage is basically a mortgage insured by Fannie Mae or Freddie Mac, which is a government-sponsored entity. They set base guidelines that you have to follow in order to get that mortgage. The typical base guidelines for a conventional mortgage is a 620 plus credit score and at least 3% down for a down payment. And that can change depending on your credit, so such as any late payments you might have, mortgage lates, poor credit history, collection accounts. It can all adjust, all of that takes into account and can adjust what the minimum parameters are. So it's not like a one size fits all, if that makes sense. But worst case scenario, it goes down to a 620 with 3% down.
So does that have private mortgage, the PMI on it, private mortgage insurance?
Yes, it does. Yeah, so private mortgage insurance, it does have it, unless if you put more than 20% down or have greater than 20% equity in the property. So if you do put less than that and you have private mortgage insurance, it will automatically drop off once you reach 22% equity in the property though.
So it's not a lifetime thing with your private mortgage insurance?
It is not, no. And it can always be refinanced too. So if you have a mortgage and you gain equity in your property, you can always refinance that property and have that private mortgage insurance removed. Does
a conventional loan have a loan limit? Is there like a maximum amount you can borrow on a home?
Yes, it's dependent on state and county. For Idaho Falls area, it's $647,200 for the loan amount. So which would push you, if you're doing a minimum down payment, the mid to high 600s.
So the minimum loan amount is $647, you said, right?
The maximum.
The maximum loan amount is $647. So if I bought an $800,000 house, then I just need to come up with the difference between that.
Yeah, if you wanted to stay inside of a conventional mortgage, you have to come up with the difference to get down to the maximum loan amount. Or there are mortgage programs called jumbo loans, which allow to go over the conventional maximum loan amount.
So what's the difference between a conventional and an FHA?
Yeah, so the biggest difference is primarily the ease to qualify. So FHA tends to be substantially easier to qualify for. Their guidelines are a lot less strict. Their credit score rate requirements are also a lot easier. And also who's backing them, right? So FHA is backed by HUD, so their FHA insures the mortgages, or HUD does, whereas conventionals for Fannie Mae or Freddie Mac. The minimum credit score on an FHA loan is 580 if you're doing the minimum down payment, but they will go as low as a 550 if you have sufficient down payment funds. So
nice.
Yeah, so if you have a 580 or above, they're going to want to see at least 3.5% down. But if you're between a 550 and a 580, they'll allow it to. You have to have a minimum 10% down to make that work.
It's not bad.
Yeah.
So, but correct me if I'm wrong here though. With an FHA mortgage, you're going to be paying private mortgage insurance no matter what the balance in your equity is, right?
Yeah, and it's actually not private mortgage insurance. It's called monthly mortgage insurance. They're slightly different. So monthly mortgage insurance is paid directly to FHA, whereas private mortgage insurance, they're private mortgage insurance providers, and you can actually obtain different mortgage insurance quotes. So when we're doing a conventional mortgage, we will actually get a quote from anywhere from 5 to 15 different mortgage insurance providers, and we can pick whatever's the cheapest. When you're doing FHA, it's called monthly mortgage insurance because that is you only have one option, and it's through FHA themselves. So that's why it's called monthly mortgage insurance. But yes, it is life of the loan as well. So
are there loan limits with FHA as well?
There are, yeah, approximately $420,000 for our county, but it is different for each county as well. So most areas around southeast Idaho are 420, unless if you get into a high cost area like Teton County.
Teton County, Blaine County, Ada County, and I think Kootenai, isn't Coeur d'Alene a little higher too?
It is, yes.
Yeah.
Yep.
So
yeah, and then another thing that most people don't take into account on FHA is there's another thing called upfront mortgage insurance. So you pay your monthly mortgage insurance with your mortgage bill, but when you close the loan, you also have to pay an upfront mortgage insurance fee, which is 1.75% of whatever your loan amount is. it gets automatically added to your mortgage. So your loan amount will always be 1.75% higher on an FHA loan versus a conventional mortgage.
I see.
Yeah.
So tell me about RD loans or USDA loans. What are the parameters there? I know not every house is going to qualify. It's based on a geographic location, right?
It is, yes. Yes, they have a constantly updated geographic location restriction. So basically they're trying to, RD's whole goal is to tailor to the low-income rural areas. So it's different. It can change as much as every day, but their online portal has the exact addresses that are allowed. You just type your address in and they'll tell you if it's eligible. It also has a map of eligible areas. But in general, most of Idaho Falls and Yukon are not allowed for RD anymore. If you get out in Iona, Blackfoot, Rigby, Rexburg, Shelley, those are all allowed. But then, yeah.
So we just have to pull up the USDA map and see where we're sitting on that house and see if it's qualified for an USDA. What kind of credit scores are we looking at there?
Yeah, so USDA technically does not have a minimum credit score. They don't publish a minimum credit score. However, they're typically governed by the lender in an overlay. So the guidelines and overlays are a little bit different. On overlays, each lender can set what they want it to be. Most lenders typically want to see a 640 or above for a USDA mortgage. However, if you meet the credit requirements, it could be as low as a 450 as long as you meet the requirements.
Yeah. So just for clarification, an overlay is the USDA is insuring that mortgage or backing that mortgage, but you're getting the loan from a different lender. You're not getting money directly from USDA. And the lender that you're getting the money from, or the bank that you're getting the money from, will have an overlay of restrictions or conditions that they'll place on top of what USDA already has in place. So that's what they call an overlay for underwriting. So
yeah, and that same overlay system applies to every loan type. So even though I'm quoting the general guidelines for a conventional FHA or USDA, each lender, depending on who you're talking to, could have an overlay to stricten those guidelines.
So, and tell me a little bit about veterans loans, VA loans.
Yeah, so VA loans are great. They allow 100% financing, just like rural development loans. They don't have any monthly mortgage insurance, which is nice, right? They do have an upfront premium depending on how often you've used your VA benefits. If you've used them, if you're a disabled veteran, there's a list of things that can either remove the upfront mortgage insurance on VA loans or add it or worsen it. And that changes every year, the amounts.
Yeah. Is there any mortgage insurance with that, PMI or monthly mortgage insurance or anything with a VA loan?
Not with the VA loan. The only loans you pay mortgage insurance on are conventional, FHA, and USDA.
I see. So for a veteran, that's a great way to go.
Yeah, it's always typically the smartest way to go because the interest rates tend to average about 0.5% lower than the other programs.
Fantastic. I do know that with VA loans, there are some certain costs, and this is a benefit for our veterans. They've earned it. There are some costs that the VA doesn't want them to be paying, such as like an escrow cost or other things as part of closing costs. What are the restrictions there?
Yeah. So you pretty much hit it on a T. So for the most part, escrow costs, I don't know that off the top of my head, but there's a list of quite a few things that can't be paid by the veteran. If the veteran can't pay it and the seller's not willing to cover credits, oftentimes there's options to have the lender pay it though. So we can issue a lender credit to cover that cost or never charge it in the first place, which can help you get around those situations.
And that's good because these veterans have earned that benefit. They've paid for it in blood, literally. So
yeah,
we like to see our VA loans. We like to work with veterans.
Yeah, I love to as well.
So one question I get commonly asked a lot of times, and I get asked by a lot of people for different reasons, is Idaho Housing. And Brady's going to tell us kind of the difference between Idaho Housing and Idaho Housing Finance Agency. They're two separate entities, basically two sides of the same coin, but they function separately. Idaho Housing doesn't issue mortgages, and Idaho Housing Housing Financing Agency is actually a lender, correct?
Yes, that's correct. So Idaho Housing is a rental subsidy place, so people can go there to apply for rental subsidy if they're renting a property. and oftentimes they provide affordable housing for rent as well.
Or what they call a Section 8 voucher, something of that nature. Yeah.
That's correct, yes. Yeah. So when you jump over to the Idaho Housing and Finance section, that's where they're actually an HFA lender, which stands for Housing and Finance Association, and that allows them to offer down payment assistance and affordable housing options such as discounted mortgage insurance. So going through an Idaho Housing and Finance loan, they offer all the same programs as everybody else pretty much. You know, they have a conventional FHA, rural development, but one advantage is you can take advantage of what's called an MCC tax credit. So you can get a tax credit every year if you qualify for it per their income limits, or you can take advantage of down payment assistance or closing cost assistance. So all the way to the point where you really only have to bring about 0.5% to the table.
That's nice.
Yeah.
For folks that need that. So if I'm understanding Idaho Housing Finance Agency correctly too, though, with their programs, there's two different programs. There's a grant and there's a second mortgage. And you have to qualify for the payment with both of them for the second mortgage, right? So if you're getting the second mortgage for down payment assistance, you've got to be able to make both payments as part of your qualification?
That's correct, yes. Yes. So if you're doing a down payment assistance loan, you get two mortgages. You get a first mortgage and a second mortgage. And that second mortgage is an additional payment. You basically make two mortgage payments each month, and you have to qualify for it.
So can you use both programs? Can you get the grant and the second mortgage?
You can, yes. Yep, you can use the second mortgage, and you can also use a grant to cover closing costs. Depending on how much of a grant you take, though, there is an addition to the rate. So if you're taking the maximum grant, it can increase the rate quite a bit if you're. Yeah.
And so for the grant, basically all you need to do with that, when you qualify, you have to qualify financially, and there's income limits and things of that nature. And of course, credit scores still apply. But with the grant, you have to make your monthly payment on time for a certain amount of time, and then they gradually forgive that grant over the course of time.
Yes,
so the longer
over
you make
7 years.
Over 7 years, you make your monthly payments on time. Over 7 years, they forgive the grant. It's just free money.
Yeah.
So, but
Yeah.
the list of qualifications for that are long and healthy. So
Yeah, one catch to the grant is if you sell it within those 7 years, you have to pay
You gotta pay it
whatever
back.
you sell or
Yeah.
refinance. So if you refinance it, it's also a lien. That lien would have to be paid off during the refinance, or if you sell it, that would have to be paid off as well. So
well, fantastic. I would encourage any of you guys to contact Brady here at Bell Financial. His information is going to be down here in the link below. And again, this has been Cameron with Grider Peterson team. Hit the subscribe button and tap that notification bell so you can be alerted to our new videos. And we'll see you again next time. Thanks.